Hello, YouTube. Could we be setting up a bear market trap again one more time? We're going to look at one simple pattern and an update. This goes back to July. We know we have a four-step recipe. 1, 2, 3, 4, 5. We're currently on number 4. So we're going to come back and talk about this in a few minutes. But we want to start with the bears because if they're being trapped, let's understand what they're telling us. Nouriel Roubini warns that a stock market crash of 10% around the world could happen. And then we got David Rosengren, who's telling us that it would be a miracle to escape a recession and the erosion of credit is similar to 2008. He's talking about how the end of summer could be a bummer. And this is really interesting because I laid out this video about 8 months ago when we talked about the bear market trap, and the S&P was at about 400. While we're a lot higher now. As we record this video, the S&P is at 451 or about 10% higher. So there's a lot of information for us to go through. Let's try to get some housekeeping out of the way so we can go through and look at things that are a little bit more meaningful. But looking here to the video from about 8 months ago, we will link to it at the end, but it shows that after the bounce off the 50 moving average, we pretty much just go to highs. And that's what we've already started here. So I'm not sure why my MAs are not actually on here. There we go. So bounce off the 50 MA, that's what started the pattern. Now we're a little bit further. So I'm really just looking for more continuation from what we laid out on this first bear market trap. Second thing is that we have to think about how far down we've actually gone. So right now we're down after a 20% rally, which we've been covering extensively. We have to ask ourselves whether or not a 5% drawdown is enough, which so far it looks like. We look here to our weekly chart, we dipped by 5% and we almost perfectly bounced. We're also doing something that we have not done ever since we formed the all-time high, which means that we put in 3 red candles, 1 green candle, and then we did not get the bearish engulfing. That's exactly what happened here and exactly what happened here. And what I mean by here is that we have 3 down weeks, 1 dead cat bounce, a bearish engulfing to close out that 5th week. 3 down weeks, 1 up week, a bearish engulfing to close out that final week. Here we don't have that. We have a second hollow candle. So the 2 yellow boxes are not currently materializing. Things are different this time, which means the trap could be continuing. However, is a 5 or 10% dip even all that bad? No. 5 or 10% corrections are very normal. In a 2019 report, Guggenheim noted that 5 to 10% corrections and the S&P have happened regularly. Since 1946, they noted that there has been 84 declines of 5% to 10%, which works out to more than 1 per year. So are we really all that surprised? I'm not. Here's where things get a little bit spicy. People are saying that September is going to be the weakest month of the year. It's going to be a crash. What we have to ask ourselves is whether or not things are similar to 2000, 2008, 2011 when we had Brexit. So that's the dot-com boom, right? That's the bust. That's the Great Recession. That's going to be Brexit. And then we got the lockdown. So unless it's something that is like really surprising us, it could be an up year. That's what we're looking at here. What's really important is that threshold of 4%, because if we look here to our graph, it's roughly 4% in 2020, roughly 4% in 2021. So for the bears, the trap, which is what I'm calling it, is that if we're looking at this pattern here, from the low to hold the inside bar, we had about 4.5%. If you look to our current candle, which is where the arrow is pointing to, from our current low of last month for August, if we were to dip down in September, we have a roughly 4% of downside before we actually hit that monthly higher low. It also implies that we're going to be closing out here right around the low of the month. And then we reverse going into the month of October. So what does that mean? It means that we could be getting a second 4 to 5% cut. If we're going to get what happened in 2020 and 2021, we're watching for that inside bar. That would be the trap where we start making progress down. The bears get a little bit too cocky, and then they get the BBC right to the face. I'm going to ask you for a huge favor, please and thank you. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really appreciate that. Thank you very much for your support ahead of time. And a small gesture like that just really goes a long way to support our channel. And we want to thank you ahead of time. All right, so that's the bear story. What we want to ask ourselves too is we got 3 down years in a row. Here we got 4, and the 4th one is the worst one. So if we think that we're repeating 2000, we could be going for a 4th one. That could be the mega crash. And the warning's going to be when we actually get a new low of the month by getting below 433 on SPY or 43.35 on SPX. So we're going to move forward now to think about, okay, well, if that's the first scenario, and we look at this data, the way they're presenting it is that over the last 3 decades or the last 30 years. What's really interesting is that there's actually a 53% chance or that's going to be 16 out of 30 that we actually have an up here. So if it's an up here, it's a 53 or just over 50% chance, but the down years are pretty dramatic. So please make sure to drop me a comment and tell me what you think. Is it a bear trap or is it a bull trap? Also interesting here is that our seasonality chart has worked really well to get us to here. We're flagging out going sideways. If we do get that leg higher, what's interesting to me is that that would actually print a new high of the month, which would mean that we're going to be getting pretty close to repeating this pattern, but not quite there because we have an inside bar and that inside bar does not break until the next month. That would be October. So this part right here could be Apple. We got WWDC coming up on September, I believe it's September 12th. So this right here could lead to a run. But if we get that breakout, I'll be watching to see if it becomes a failed break. And ultimately, if we do go lower. What's interesting here too is that if the seasonality chart does play out, we got low, higher low, higher low, higher low, and then a little bit of a lower low into October. But then it's a straight rally to end the year off, which would mean if we get October up, then we got November, December, right? We got all these up months right here, which could start the next leg of this rally, getting us to all-time highs. And this might seem like a little bit of a stretch for SPY, but look at what XLK is doing right now, which has a larger weighting for Apple and Microsoft, already in blue sky territory right here. All right, so moving forward, we talked about this, right? The bear case. These bears are loud, they are vocal, they are not nice. It would be a miracle to escape recession. And he's calling for a massive drop again. At the end of the summer is going to be a bummer, is what he's saying. It could be like 2008. And that seems a little bit scary. Here we go. Rosenberg's thoughts. Doves becoming more vocal. Employment growth is slowing. Recession could be in the cards. Cool. Then we got Nouriel Roubini, which we talked about before, telling us that stocks could drop 10%, which is completely normal. But over here in bull camp, we got Tom Lee. 4 reasons we see the S&P gaining 2 to 3% in September. Cool. Then we also got Morgan Stanley here saying that in a matter of months, I'm talking 4 or 5 months, they think we can rally 11% from here. WTF? How are we going to rally 10% from here? 10% from here pretty much means that we're going to be right around 500. So we're going to add about 45 points. So if we go up 10% from right here, oh my goodness, we're going to be a 495 on the doorstep of heaven, right? That stairway to heaven could be taking us there. And something that I'm trying to keep in mind here is that we have a Fibonacci retracement, which goes from all-time high to the low. But if we do look at our next extension, it's actually all the way up here at 560. So could that hit? Could we actually be going all the way up to get that next leg higher, which could manifest itself by getting all the way up here to about 560? That's the big question. All right, and we also got Goldman's Hatzius cutting odds of recession to 20% in the next year. The bulls are rejoicing. The soft landing is here, and greed is back. So because greed is back, we want to be mindful of this. We got a brief dip down into fear, and now we're right back here into greed. So technically, we've bounced back. We got a nice solid hammer here. And then sentiment-wise, we notice kind of that same thing. We notice that there is a lot of trades that are happening, but at the end of the day, like people are back to greed here. So I find that really interesting. Something else that I would want to note is just that the CFTC net short positioning is actually a little bit more bearish, but they've been on a steady path where they just cover. So if they decide to go net long, like we've been joking about for a while, short, double down, net long, short, double down, net long. They keep doing it over and over. So if they do that, we're probably going to go higher if they do go net long. We can also note that 5 or maybe even 10% correction we talked about in September, we have not had a 10% correction so far this year. So if we look at our biggest drop, let me actually just double check this to make sure I'm not full of actually from 418. Let's actually do the math right here. So we got 380 divided by 418 minus 1. Might even be our 10% correction. That's a 9% correction. So we got a 9% correction right here, and now we got a 5% correction off the top. So we got a 9, we got a 10. Is that close enough? Did we get enough of a dip? So 9% on the first cut, 5% on the next one. Let's look and see what's actually going to happen. All right, and this is going to be interesting because there's not actually all that much data coming out this week. We have a Labor Day coming out on Monday for the US and for Canada. Happy long weekend ahead of time. We've got the only really important data point I'm going to be watching is going to be the Bank of Canada decision on Wednesday because it could be signaling yet another pause. And Goldman Sachs is saying that Canada is to skip now and then add a final hike in October. I find that interesting. So there was a surprise drop in GDP, which is leading to a little bit of growth scares. We also saw that the dollar gained dramatically on Friday. Due to what? Well, it's in part due to the Canadian dollars. We look here at BXY, but if we look at the underlying asset of USD versus CAD, we notice a bullish engulfing candle, and it's actually up by about zero point 0.6 on the day. That's a pretty big move for a currency. So that's on the back of that weak data. Otherwise, we have initial jobless claims coming in on Thursday, but it's really a light week. We're going back into a normal trading period, which means sell in May and go away and come back on Labor Day. Well, Labor Day is right around the corner. So let's look at a couple of charts to see exactly what is happening here, because on the weekend review, we like to focus on higher time frames, and this weekend's going to be no different. So for this week, unless we get to 460, my base case is that we're going to form some kind of consolidation on the monthly, just like we did over here. If it does or does not happen, I'm just going to be receptive to reacting, right? I'm not going to try to predict what's going to happen here. I'm more interested in reacting. So I want to be reactive, not proactive. I think we're going to go higher, but I think does not translate to I know. So I think we're going to go higher as long as this pattern keeps playing out. And a really big clue for that was that we're actually back above the previous weekly high. When we blew through that at 445, we talked about how we could be making a run. Well, we did. Where did we go? Right here to our mathematical number. It's like math is in play here. So if positioning is roughly in line, sentiment is roughly in line, are the charts in line? Look at this number right here. All it means is that from our high to our low, we've now bounced back about 78% or about 80 cents on the dollar. If we look over here to QQQ, it's basically the same thing, but it's leading. From the high to the low, we've now bounced back to this line right here, which is the 78.6% retracement, which is at 375.66. Where are we right now? 377.59. We're getting a pass or a bounce off the uptrend, and it looks like we could be holding it here and then maybe making an advance. If we're going to break down, it just means we're going to lose the uptrend. That's what I'm watching for. Second reason why this is quite notable is because we got our 5% dip on the S&P. We got the directional break, which is the short-term trend. And we note that we actually also bounced off previous resistance. So that's turned into support twice with higher lows. That's usually pretty bullish. If we take the same note here, so after we have a dead cat bounce to an inside bar, the direction of the break is likely the short-term trend. Let's look back here to our monthly chart. What do we have? A dead cat bounce, an inside bar, which means whichever way we break is likely going to be that short-term direction. Let's keep in mind, though, that we're still pointing up, which means we have an uptrend. We've stopped pointing down, which means we've lost our downtrend. And unless we crash land all the way down to about 412, I don't really see us actually breaking that trend. So the bears think we could drop as much as 10%, that Nouriel Rabini, which means they think we could break the chart. If we go below 410, yeah, I would say I might be wrong. We're now back to the 50-yard line on the retracement at about 414, and that would start to get me a little bit more worried. I also have a recipe of things I'm looking for specifically to see whether or not this rally has more legs to it. We're going to look at the daily chart, but I'm just going to ask you one more time, please and thank you. If you could please consider smashing that thumbs up and subscribing to the channel. I know it seems like a small gesture, but I would really, really appreciate it. All right, let's look over here to our 50 DMA club, because there's some that are below, but some are actually now making a move back above. So I want to tell you why these things are important. It tells me whether or not we're trending above the short-term price, because if we're not above the short-term price or the blue line, it's going to be very difficult to go up in the longer term. We're going to flip the candlesticks as well just to make it a little bit easier. I personally prefer hollow. So S&P is over. Canada, right, on bad news, is now over the blue line, over the black line. That's good. So if we get some bad data that fulfills in the US like we did here for America, I think a lot of this is just related to the dollar strength on Friday. So we note that we had the dollar up by about 0.6%. And we note that we now have 4 consecutive daily candle closes back above that 50 DMA. Pretty constructive to me. This looks pretty good. So let's go to the XIU. This is Canada. It's like the S&P 500, but they call it the S&P 60 because we're just not as good. We only have 60 companies. Drop me a comment if you agree. Is Canada as good as America, or is it better, or is it worse? QQQ now has 4 consecutive daily candle closes over that 50-day moving average as well. And because QQQ is above its Fibonacci area, it's really important. We see chips leading tech, tech leading SPY, SMH here, 4 consecutive daily candle closes over. Here's where it starts to get a little bit more tricky. So NVIDIA, still way above, nothing to complain about here. Apple now has 3 days over. Again, we got that big WWDC event coming up. Let's see what Apple delivers. Is it going to be an update to the phone? Are they going to fill the gap and go higher, form some kind of cup and handle, bounce off the 50 and go to new highs? And this is notable because we're already at new highs, but not a lot of charts are actually joining Apple here in blue sky breakout. So Tesla actually rejecting off the 50 MA here. That looks notable. We got FXI back over, but only for 1 day. It's not enough quite yet, not a trend change. We need to see at least 2. So now we're back below. Microsoft is still below. That's the second biggest stock in the market. We can look here to ARK, not quite above yet, trying to gather up steam, but not quite there yet. We can look here to the DAX. It is not above. I think it maybe spent 1 day above, but now it's right back below. We'll look here to the emerging markets. It is not above, trying to gather up steam just like ARK. We'll look here to the Nikkei. It's now above for 2 days. So Nikkei is over. China is above for 1 day. Emerging markets are below. Ethereum is below. Bitcoin is below. A lot of charts are below. So this matters for me because I want to see that the risk on sentiment is not just an American story, but it's actually a wider story being shaken out to other asset classes, notably like something like an ARK or a Bitcoin, because when we look at the heat map, the story is a little bit different, whether we look at a short-term trend like a 1 week where things look pretty good, looks like they're buying most stuff, but on a 1 month or the last 30 days, this is where things look a lot more bloody. So we could have a little bit more blood coming here, but I believe, not I know, I believe that we could be heading for a bear trap, where we do go to new highs. So if you want to watch the update I laid out 8 months ago, that'll now be queued up here on the right-hand side. If not, maybe you want to consider joining us at thealgo.com to trade with me, Justin from YouTube, to see everything I do after I sign off YouTube, to formulate a plan and try to make some money. If not, thank you so much for tuning in, and I look forward to seeing you on our next video. Thank you.